There we go. I need to actually add myself into this other live. I'm doing something, guys. I'm going to be moving my head around a little bit. I'm doing something that I've never done before, which is that I'm going live on Instagram and LinkedIn and YouTube all at the same time. So thanks everyone for joining on all these multiple different platforms. We are, of course, here today to discuss, if you can hear me, the latest news from the Bank of England. Now, I have got my mic here, so I've never done this before. This is all very new to me, to try and do multiple things at the same time. I've got myself on my screen here on my laptop. I've got myself on the screen up here, and then I've got my other big screen over here, which is where I've got the Sky News and the BBC News websites, where we're going to be discussing and reacting to the Bank of England's base rate announcement that is going to be coming up in about 10 minutes time. So what we're going to do in the meantime is have a little look at some of the it looks like Butlins was sunny. For all of you who don't know, I was in Butlins last week, taking my missus little one away. Actually, this is from Edgbaston. This is an Edgbaston shine. I was at the cricket on Sunday to watch the Stokes masterclass. So a bit of heat stroke. Also got a bit of a sore throat as well today. So apologies if the sound isn't fantastic. So shall we get into talking a little bit about what's actually going on, or some of the things that have been discussed sort of in the lead up to this. So let's start with Sky News. I actually think Sky News is a little bit better than the BBC sort of feed on this kind of stuff. So let's start there. So first thing that I found is prospects of first interest rate cut hanging in the balance. Lots of us guys have been discussing, haven't we, over the last couple of weeks, whether or not we think the base rate is actually going to come down. I think going back pre-general election, it seemed as though a base rate cut was on the cards. The bookies have cut the odds of that, or have increased the odds, I should say, of that actually happening. They don't believe that it's going to happen. But James Sillars, the business reporter at Sky News, says anyone who can tell you with certainty what the Bank of England will do today is frankly a mug. The prospect of a first interest rate cut is hanging in the balance. It has been dangled seductively by the bank throughout this year, only to be withdrawn month after month as elements of inflation remain too high for the liking for the majority of the rate setting committee. After the sacrifices of after all the sacrifices of the cost of living crisis to date, lower borrowing costs are closer than ever, but still not nailed on, having risen as far back as December 2021. So guys, let's add some context to this. Do I personally think the base rate is going to go down today? No, I don't. Do I think it might go down in September? I actually am not too sure about that either. The issue that we've got at the moment is that there are the normal rate of inflation, which is the CPI, which is just how the easiest way to sort of look at whether or not the economy is going as anticipated, is at 2%. The target is 2%. So people are sort of going, well, hang on a second. If it's at 2%, that's the target, then why is the base rate still so high? Why are they still trying to push this down? And that's all, all well and good. This is all great, but that's not the total story. It's not the total picture, because there are two other inflation rates that we need to be aware of, which one of them is services inflation. And services inflation takes into account the services and that sort of stuff. And that is as high as 5.7% at the moment. So year on year, the cost of things like going to see a concert is actually up 5.7%. And this was actually anticipated to get down to as low as 5.1% during the last announcement of the rate of inflation by the Office of National Statistics. So that's quite a big difference. And whenever we're not predicting that the base, whenever a prediction doesn't come true, particularly if it's on a more negative, in a more negative way, then that unfortunately has a negative knock-on effect to things like the Bank of England's base rate. So we'll see how this goes. So following on from this, basic wage growth eased from a stubborn 6% level in June, but services inflation remains 5.7%. We just mentioned that. So wage basic wage growth. Okay, this is another massive thing that is kind of being swept under the carpet a little bit by the media, who and everyone that's pushing for the Bank of England to reduce its base rate. Well, while wage growth is as high as it is at 6%, that's like as high as probably anywhere in the world, and as that means that the UK is increasing its surplus income. Essentially, the average person has more money in their pocket this year than they did last year, and so the Bank of England have to be really wary about reducing inflation. Reducing the base rate, because we are getting inflation down to a manageable figure, but because wage growth is still so high relatively, if we reduce it too quickly, then inflation will just pop back up. And it's actually expected that inflation is going to pop back up next month above 2% again. So, who knows? Will swap rates move much? Swap rates have actually already started to come down. We'll probably talk about that a little bit more after we get the announcement, because I want to talk a little bit about predictions first and foremost. So let's have a little look down. A poll of economists by the Reuters news agency found a small majority backing a cut to 5% from 5.25%. Financial markets see a 64% chance that happens. So it is still seen as that we will get a base rate cut today, marginally, a 64% chance of a base rate cut today from 5.25 to 5%. We shall see. Let's have a little look and see if anything new has come in on top of this. No. So just give you guys, just so you're aware, I'm scrolling through some of the news stories ahead of the announcement. Annual house price growth reaches fastest rate since December 2022. Annual house price growth has picked up to the fastest rate since December 2022. UK house prices rose 0.3% month on month in July, which was reported by Nationwide Building Society. This resulted in a slight acceleration in the annual rate of house price growth from 1.5% to 2.1%. Across the UK, the average house price in July was £266,334. So this is showing a little bit that this should actually be kind of like a positive thing. The Bank of England should be looking at this and going, well, actually, the base rate is where it is, but the property market is still progressing forward. So will that impact negatively on whether they actually want to reduce the base rate or not? Because one of the reasons why the base rate, why people want the base rate to come down is, of course, because we want mortgage rates to come down, so mortgages are more affordable and people can move home. But if we are seeing the property market, the housing market in the UK is still progressing forward and is still growing, maybe that's a reason not to reduce the base rate. Who knows? GPs vote to take collective action for the first. Is this really important? Breaking news. No, it's not that important. I'm not going to talk about that. I don't want to talk about GPs. Should we look and see what's on the BBC website? How do interest rates impact inflation? Quite useful. How do interest rates impact inflation? The Bank of England has a target to keep inflation at its current rate of 2%. The traditional response to rising inflation is to put up interest rates. This theory is that by making borrowing more expensive, people have less money to spend and in turn buy fewer things. We are a nation. The Western world is a collection of nations of consumers. We borrow money. You only have to look at the US to see they buy everything on credit card and then pay it off at the end of the month. That's pretty standard in the US. But we are a country of borrowers in the UK, in terms of we will borrow to buy things. We want a sofa. We borrow to buy a sofa. We want we want a car. We borrow money to buy the car. I think no cut today. 64% chance of us having a cut today, apparently. So let's see. But it is a balancing act. High borrowing costs can also lead to businesses borrowing less, making them less likely to invest and create jobs. Fantastic. Yeah. I personally believe, I've just been on the phone to a new client, and we were talking about how I believe that this new government needs to really support business in the UK a lot more than the previous government. Don't think that's going to happen, but that's how we can get the economy to grow. We need to be investing in businesses and business, and make it more feasible for businesses to survive and thrive, and that will have a really positive impact on our economy. This can impact economic growth, which has been sluggish in the UK for some time. They've got a nice little graph underneath. Economists split on whether bank is ready to cut. We learned in June that inflation had returned to its 2% target, but it's still not a done deal that the Bank of England is ready to start cutting rates. The bank's job is not just to get inflation down, but to keep it there. And there are several factors it has been concerned could result in price pressures re-emerging. These are the strengths of wage growth, inflation in services sector, the likes of hotels and restaurants, and economic growth. Data on those have come in stronger over the last month than the bank's Monetary Policy Committee had expected. On the other hand, goods inflation remains very weak, whilst unemployment is creeping up, which could dampen wage growth. Right, let's get back onto Sky because it's midday, which means we should get we have had the base rate has been cut. The base rate has come down for the first time. Okay, I was wrong. Major boost for mortgage holders as Bank of England finally cuts interest rates. The Bank of England has cut the base rate for the first time since the cost of living crisis began. The bank's Monetary Policy Committee cut the country's main interest rate to 5% from 5.25%, where it has stood since August 2023. Yeah, that's right. Amid the cost of living squeeze, the base rate cut has climbed steadily from the ultra low era of 0.1% in 2021. Rates were elevated to combat high inflation. They do this by encouraging saving and discouraging spending. When this happens, price rises tend to slow. With inflation now at target of 2%, the path to lower rates appears to have begun. A cut is positive for mortgage holders, but less for savers. I mean, look, guys. Let's put this into context. Is it good news that the base rate has come down? For a lot of people, it will be. However, it's 2.25%. We have already seen that mortgage lenders have started to reduce their rates a little bit on the back of swap rates coming down over the last couple of weeks. But this is only a marginal reduction. We were at 0.1%, as they were saying, not so long ago. We're now at 5%, having been at 5.25%. So in terms of that growth over that period of time, it is only a small margin that it's come down by. I think it will probably stick at 5% for a little while now. We are anticipating that inflation is going to go back up in July, which will be reported in a couple of weeks' time. I'll be going live again to report on that. But as a result, I think they'll stick at that. I think this might be, maybe there's a bit of outside pressure on this to push it down. So yeah, we'll read a little bit more into that. The bank's 9-member Monetary Policy Committee voted 5-4 to bring borrowing costs down, bringing to an end the joint longest plateau for rates since the bank was granted independence in 1997. So that's quite interesting. I always find it. Right, Blix, well, you need a remortgage by the end of November, so you know where to come. Send me a DM, we'll get on a call and we'll get that remortgage sorted for you. So I always find the Monetary Policy Committee voting quite interesting. They voted 5-4 in favour, so it's only literally one person in favour of one person difference in favour. So it really was on a knife edge. I mean, that 64% chance sounds about right because it's 5-4 in favour. It could have very, very easily, if one person had voted to keep it the same difference, that would have made the difference. So it really was on a knife edge, and that says to me that the Bank of England are still being quite cautious about what they're doing. I personally think there might have been a bit of pressure from outside for them to reduce it after it didn't go down last month as many predicted it would do. So let's see. The lower interest rates will instantly be reflected in many savings accounts and floating mortgage rates, though those selling fixed rate mortgages had long ago reflected the likelihood of lower rates. So as I was saying earlier, guys, we have seen some marginal reductions in the average cost of a mortgage over the last week or so. That may very well continue a little bit. For those of you that are watching me, generally speaking, it's because you're in the property game. And if you are, then you're probably more interested in buy-to-let mortgage rates than you are in residential mortgage rates. And I think where we'll see the improvement in the cost of a buy-to-let mortgage will be on the fees that lenders charge. For quite some time now, I've been talking about the fact that where buy-to-let mortgage lenders in particular have been trying to focus in on reducing their mortgage rates, is so that they can lend money out, because how much they can lend you on a buy-to-let mortgage is based on the rental income that the property generates, not your personal affordability. So if the rental calculator doesn't work when we've got rates as high as they are, they need to reduce those rates down so they can lend the 75% magic number that they need in order to get the money out the door. And then what they've done is they then stacked their fees that they add on to the loan. So instead of it being an average of 1%, 2%, or 3%, it's now become an average of 4%, 5%, 6%, 7% being added onto the loan. And that's where they're making their margin. That's where they're making their money. So that's basically what we've got to try and that's basically what I think that's the impact I think we'll start seeing over the back end of this year. Is I don't think the average cost of a mortgage in terms of interest rate from a buy-to-let point of view is going to change too dramatically, but where we will hopefully see a positive improvement will be in the fees that are being added to the loan. So I'll be reporting on that as best as I possibly can and keeping you guys in the loop. But I think the good news is that any of you that are looking to remortgage over the back end of this year, things are starting to improve. And obviously, as you all know, if you need to look at your remortgage, I would thoroughly recommend start doing it at least 6 months in advance. So get in touch with me. If you're watching on LinkedIn or YouTube, just drop a comment below. I'll be in touch and we'll get a call booked in with me or one of the team at Grand Union Finance to organise that for you. If you're watching on Instagram, send me a DM and I'll get and we'll organise a call so one of my brokers can sort out the getting that remortgage sorted for you ASAP. But we're getting a little bit more analysis coming now. So Ed Conway, who is the data and economics editor at Sky, has said it's been a long time coming. After 2 years during which the Bank of England raised interest rates at nearly every meeting, and another year in which those rates sat at what is for many households and businesses a painfully high level, today they've finally been cut. So this is a watershed moment, a critical turning point for the UK economy. Interest rates are the bank's main tool for trying to control inflation. Higher rates deter people from borrowing and encourage them to save. Hence, less money gets spent out there in the economy and retailers become less confident about setting high prices. High interest rates are, to put it more bluntly, a form of economic pain. And the bank thinks that even at 5%, where they are now after today's cut, they are still at a painful level, or as they would put it, a restrictive territory. This is a large part of the explanation for why unemployment is higher, house prices are lower, and for why many households are still struggling, even though the annual rate of inflation is now back at the bank's target rate of 2%. I think this is critical, guys. I think this is really, really interesting that the bank itself has come out and said that they fully understand that even at 5%, that is high compared to where they would like them to be, but they feel for whatever reason that they can't reduce it any further than that. I mean, for me, I think we need to be really, really cautious in our approach here, and the Monetary Policy Committee need to be really cautious in their approach to reducing the base rate and doing it slowly. Because what happens? Hi Simon, how are we doing? What happens is that when we saw the very speedy increase in the base rate a couple of years ago from 0.1 to 5.25, that caused a lot of turmoil in many markets, not only just the mortgage market, but many others, the economy in general. And if we did the opposite of that, we're going to have a similar situation occur, basically. So we need to be really cautious here. A reduction to 5% is great. For me, if I was the Monetary Policy Committee, I'd probably hold until maybe November or December now. Let the lay of the land lie. Let's see what happens with the budget, because let's be honest, that's coming up in October or November, and that could have a significant impact on what's going on in the economy. Following on from this now, the big question now is what next? First things first, don't expect those borrowing costs to come down as quickly as they went up. Markets think they might be one more cut this year. Markets think there might be one more cut this year, as I've just alluded to, and that borrowing costs will come down quite gradually. Second, few people inside the bank expect borrowing costs to come down to the levels they were back in 2021, where they were sitting at a historic low of 0.1%. Instead, they seem moderately happy with the market expectations that rates will drop only to about 3.5% over the next 3 years. I would agree with that. I think 3.5% by sort of 2028 is probably about right. And so over that period of time, then that's where you'll see, this gradual change. And as I said, I think that's going to be a really good thing. Interest rates are still in restrictive territory then. So are interest rates still in restrictive territory then? That is a question no one at the bank wants to answer. The bank's decision today wasn't exactly a surprise. Financial markets had put the probability of a rate cut today at over 60%. I thought they would hold it for another month, but there we go. Even so, it was perhaps the most finely balanced decision in a long time. Far from being a unanimous verdict, 4 of the 9 members of the Monetary Policy Committee actually voted to leave interest rates at 5.25%. This wasn't, in other words, a slam dunk. Very, very true. So that's why I think next month we'll probably see it stay at 5%. Maybe even see it stay at 5% in October as well, maybe November or December, once we've had the budget, once we've seen how inflation reacts to this base rate cut. Maybe we'll then start to see, further reductions occur. But I also think there's a decent chance this might be this might be the last one we get this year. So why will it be gradual, not been so in the past? It's because we need to set the lay of the land. Quick changes lead to negative impact. We've seen that when it was on its way up. The same thing will happen when it's on its way down, as I've said before. If the Bank of England reduces its rate too quickly, we will just see inflation shoot back up again and we'll be back to square one. So we've got to do this in a gradual rolling out fashion. Far from being documents released alongside the decision were chock full of provisos. Rates would need to remain restrictive for sufficiently long until the risks to inflation returning sustainably to the 2% target in the medium term had dissipated further. Basically, that's a different way of saying exactly what I've kind of just said, which is that we now need to see what the reaction is going to be to inflation for the base rate coming down. We need to see that it remains low for a decent period of time, and then we need to and then we can make the Bank of England. I say we, like I'm part of the Bank of England Monetary Policy Committee. Then a decision can be made to see how this goes down. In other words, we're not out of the woods yet. The bank is still paranoid about inflation, as I would be. Then again, it always was. And today it finally cut interest rates and signaled there will be more to come in the coming months. Okay, so that's cool. So let's see what else has come back. MPC votes 5-4 in favour of the cut, but it could be the last for a while. The Monetary Policy Committee voted 5-4 in favour, as we just know. With Governor Andrew Bailey the deciding factor. So actually, Andrew Bailey voted for it to come down. Now that's really interesting, guys, because a couple of months ago, Andrew Bailey came out after the base rate wasn't cut yet again and said that not only will the Bank of England need to see that the base rate, that the rate of inflation meets the 2% target, but needs to stay there for a period of time before the Monetary Policy Committee would consider reducing the base rate. He's essentially gone against what he said that he would do. So he obviously feels personally that there is, there's a strong enough argument that the rate can come down a little bit. As it's already been reported in here, and as we've been saying, 5% is still what we would call a restrictive rate. It's just not as restrictive. It's starting to push things in the right direction. So hence why maybe they thought we'll get it done, we'll get it in, we'll get this reduction happening, and then we'll sit on this for a little while and we'll see how things go. The last meeting saw members vote 7-2 in favour of holding the rate. Our business presenter Ian King says the minutes of the meeting note earnings growth fell to 5.6% in the 3 months to May, and services inflation is coming down. So that's probably the reason. we said it before on many lives in the past, and I've said it on this live right now, that services inflation and earnings growth are probably two of the biggest factors. And if the Monetary Policy Committee feel confident that these are heading in the right direction, that's probably been the straw that's broke the camel's back in terms of getting inflation down to, getting the Bank of England base rate to come down. So the bank satisfied that inflationary pressures are starting to ease. However, I think that you can take from the minutes, and the voting split might be that this will be the last interest rate cut for a while. The market is pricing in another rate cut between now and the end of the year, but it looks like this decision was pretty finely balanced. Yeah, that's really interesting. And that's why I find the vote probably one of the most interesting parts of this, because basically we want it tells us that 4 out of the 9 didn't want to reduce the base rate today. Okay, so now that it's been reduced, it's a very, very good chance that those 4 are going to vote again next month for it not to be reduced. So we only need one of the people that did vote for it to be reduced today to vote for it to not be reduced, essentially, for it to swing in the other direction and be 5-4 in favour of holding. So, and I would probably suggest that at least one of those people will vote next month for it to hold. And there's a good chance then in October that might also be the case. Because not only have you got to convince the people that have already voted for it to come down to continue voting for it to come down, but you've got to then you've got to convince the people that have voted to hold it, that after a decrease has already taken place, to actually then vote to decrease it further. So yeah, it's pretty interesting. I tell you what, Rachel Reeves is the gift that keeps on giving. Chancellor slams Liz Truss over high mortgage rates despite rate cut. Honestly, I swear to God, I would love to lock Liz Truss and Rachel Reeves in a room together and just put a camera in there and then see what happens. She freaking hates the woman. Bless her. Poor Liz Truss. We've had a reaction from Chancellor Rachel Reeves to the cut in the base rate. In a statement, she says, while today's cut in interest rates will be welcome news, millions of families are still facing higher interest rates after the mini budget. It's not just the mini budget that was a result of this, okay, guys? It really wasn't. She is a broken record. That is why this government is taking difficult decisions now to fix the foundations of our economy after years of low growth, so we can rebuild Britain and make every part of our country feel better. On the other side of the political aisle, Shadow Chancellor Jeremy Hunt is trying to present the rates cut as the outcome of his party's prudent management of the economy. I think there's a decent shout for that. He said, today's cut will be welcome news from millions of homeowners and shows that Labour inherited a stronger economy, which was on the right track. In government, we took difficult decisions to cut inflation from 11.1% to the bank's target 2%, paving the way for lower rates. Our concern is that further substantive cuts may now take longer because of inflation busting public sector prizes rushed through by the Chancellor ahead of the summer. I think there's of the two of them, I tend to agree a little bit more with Jeremy Hunt on that than I do with Liz Truss, with Rachel Reeves. But there we go. So, guys, headline news is that the Bank of England's Monetary Policy Committee has, in fact, voted for the first time in years and years and years to reduce the Bank of England's base rate from 5.25% to 5%. The outcome of that and what the impact on the economy and in inflation still remains to be seen. We're going to be back in another couple of weeks for the Office of National Statistics announcement of the new rate of inflation. How will the Bank of England's base rate cut affect that? Who knows? I'll be keeping you posted on all the news. Of course I will. Don't forget, guys, if you're watching this on YouTube, to subscribe to the channel and please like this video. If you're watching this on Instagram, it's going to be on my feed very shortly. Please share it to your stories. I'll be very, very grateful if you could. And if you've got any questions on YouTube, this will be now on my channel permanently, so you can drop comments below. Any questions you've got on anything to do with the Bank of England's base rate, the impact on mortgages, please drop it on Instagram. If you guys do you have any questions, just drop me a DM. I'm here to help. And if you're listening on the Game of Loans podcast, because this will be going on the Game of Loans podcast today, then please don't forget to write us a lovely 5-star review if you've enjoyed this episode. Guys, everyone, thanks for joining me live today. It's been an absolute pleasure to give this great bit of news to you all. Hopefully you've enjoyed it. Thank you for choosing me to come and watch whilst this was announced. And I hope you will have a fantastic day. See you all later on. Goodbye for now. And now I've got to end them all.